And we have another day in these markets, which is about all that we can really say about it because nothing has really changed. There's been a bit of a bounce in equities. There's been a bit of a reshuffling in the currency market, a little bit of a reshuffling in energy and in bonds, but ultimately nothing has really gone anywhere. And so as we wait for these markets to come up with some sort of path of least resistance here, as we consider what may be the next step forward here, we are going to take a little bit of a detour. This is a Macro Money, of course. I'm Ilya Spivak, head of global macro here at Tasty Live. And the focus for today will take us to the crude oil markets, because here we have something of a disconnect. And this is a disconnect we've talked about before. We've discussed as of about 3 months ago this idea that crude oil has been motivated less by supply and demand dynamics, despite the perception that those dynamics ought to be motivating it, and perhaps even are. The evidence didn't seem to hold up, and so we surmise, well, maybe this is sentiment motivated. Maybe this is, as it were, fearing fear itself. This idea that we have a pair of wars going on, and although they don't seem to be disrupting anything at the moment, they potentially could. And this is why we have a sort of upward dynamic in the crude oil markets since really the beginning of the year. And so what we'll do here, of course, that dynamic has changed somewhat, but nevertheless, we've seen over the course of the past month a spirited rise. So what we'll do here is we'll update on whether our logic still holds and whether the recent bounce that we've seen now sets up a viable selling opportunity. So let's first take a look at what crude oil has been doing. So we can see here it was a trend higher since the beginning of the year. That, since our conversation in late March, has changed. So we talked then about the idea that this move, as we've just mentioned, made relatively little sense from a supply-demand perspective, and that it probably reflected geopolitical disruption possibility. Since then, of course, that show was on the 25th of March. I checked ahead of our show just here today, and very shortly thereafter, we can see here from the beginning of April, there is a significant decline, and the trend since the beginning of the year is actually violated to the downside. What's happened then, and of course that was a lucrative short, and we enjoyed that. Since then, what we've seen is a very curious rebound over the course of this month, and that's this right here. Now, not only has this rebound retraced back into erase this latest leg of the down move, it's actually taken out the resistance that was set up here by the top of this consolidation range. So ostensibly, this looks like it may be breaking higher. It hasn't quite violated the underside of what this was right here. So I wouldn't go so far as to say this is a confirmed upside breakout, but the technical picture, just in the most simplest of terms, where higher highs and higher lows are a trend higher, that's here. Lower highs and lower lows are a trend lower, that's here. We now seem to have something that appears to violate the trend down here, in that we've set a higher high, and that is threatening to open further gains. if only it were to overtake the underside of whatever this was right here. So it behooves us, I think, at this point to check our logic. We're going to get data tomorrow that ostensibly is going to show us a second consecutive week in declining inventory. So last week we saw some surprising numbers, unexpectedly large outflow from the front of the supply chain from crude inventories, and likewise declines downstream in gasoline and in distillates. So refined product inventory also down. And the expectation is we're going to get more of that in this most recent edition of this data. So ostensibly, we have the ingredients for maybe a little bit more of a increase. After all, if there is reduced supply in inventory, both of raw stock, of crude stock, and of refined stock, well, then ostensibly you need much more to come through the entire system. That might be a bump to the price of crude here. But if we pull back a little bit to the overall story, its outlines remain generally the same. Consider here that at this point, U.S. crude oil output is hovering at the highest on record. It hit 13.3 million barrels by the end of last year. As of now, it's inched back just a touch to 13.1 million barrels as of the first quarter. So we're looking here at a sea of output. And what's interesting here is that since really the beginning of last year, and most recently late last year into the beginning of this year, we seem to have established something of a bottom here, despite the fact that output continues to climb, which is a bit of a disconnect. You would expect, of course, that with increased output, you would get some sort of a degree of downward momentum. Now, of course, you can see very clearly here output is rebuilding, but the price is going up. But this is, of course, the recovery from COVID. We can see here that generally speaking, as we've had the shale revolution and output has increased, the trend in crude has been down until COVID. That, of course, shuts down the global economy. We get a massive decline in output, but the price falls also because this is a story of lockdown and absent demand. Then things normalize. You get a big rally back in crude, even as output increases, because what you're doing is you're shaking off the lockdowns, you're shaking off the pandemic disruptions. But now you would think you've done that. You would think that's in the market. And so the larger dynamic of record output might be giving you more of a reason to think crude oil ought to be going down at this stage. Not only are we at record output, we're apparently getting much more efficient at generating it. So consider the U.S. uses about 20 million barrels of oil a day. At 13-ish million barrels a day that we're currently producing, we're very near self-sufficiency, needing no imports from anywhere. And interestingly, we've gotten here with the number of rigs. This the blue line here is the Baker Hughes count of operational rotary rigs, sort of your classic oil rig. And in the red is the accounting from a consultancy called Primary Vision of operational fracking rigs. And we can see in both cases, we are very much going down, even as output decreases. Here is the peak, or at least the pre-pandemic peak for both. Obviously, they collapsed during the pandemic, during the lockdowns. Then we had the corrective sort of recovery after those lockdowns. But we can see here, we are making record numbers of crude oil, but the number of rigs of either stripe that it takes to do that is trending down, really since the beginning of last year. Which is to say, we're getting more efficient and ramping up from 13 million to 20 to fully cover the gap. Doesn't seem like a stretch at all. In fact, if we look at the trend in imports and exports, it's unmistakable. Imports are trending down. Exports are trending up. There is more than enough oil, it would seem, for this to be the case. Diverting only some of this would already begin to close the gap. So there should be really no supply issue to talk about here, uplifting crude oil. In fact, if we look at net exports, this is a 4-week moving average, we can see that net crude oil imports here have been declining basically since a peak in around 2005, 2006. And of course, crude oil has edged lower in tandem until this pandemic sort of disruption right here. The drop, the rebuild. And we seem to have been arrested here on the way down for reasons not having to do with some sort of a shortage, not having to do with at least domestic undersupply, which appears abundant. What's more, if we look at how much storage capacity we have, if we, for example, wanted to add more oil and produce more, we're only about, let's say, on average, between 40 and 60% full for the major sites that are tracked by the EIA, which is a part of course, the Department of Energy. So we have here ample storage. Again, suggesting there is no supply concern here. We could ramp up more rigs. We could store more oil. We could get to where we need to be for full self-sufficiency in relative hurry. Maybe the international picture is changing. Well, certainly doesn't seem to be. The main force in the market here attempting to tinker with shaping the price with output cuts, OPEC, they don't really seem to be doing much of anything. Here's what the output structure has looked like recently, and we can see for all of the talk about them cutting output, for all of the speculative fervor around every single OPEC ministerial meeting in the media and in the markets, this hasn't really moved. Whether it's OPEC at the core or the expanded group of like-minded producers. This is not really going anywhere. And of course, this is the forecast bit of the story here, in so much as looking past this year into next. But as we can see here, this has been basically steady for over a year. In fact, if we look at the EIA's estimates for where crude oil is heading from here, we can see this year realized numbers still give us a little bit of a gap where consumption is outpacing production. But going into next year, the balance changes. And the expectations are actually that we are going to see output outstripping crude oil consumption. Again, for forward-looking markets, not exactly the recipe for gains. So once again, we are taken in the direction of considering, well, maybe this is geopolitically motivated. Maybe this is somehow a function of what's going on in the Russia-Ukraine theater. Maybe this is somehow a function of what's going on in the Israel-Gaza theater. And indeed, I think if we look at this geopolitical risk index, this was put together by Fed economists and is a kind of benchmark for this this kind of risk, to give credit where it is due. Fed economists Dario Caldara and Matteo Iacoviello developed this. And what they do is they essentially look at various categories, be they war threats, military buildups, terror threats, escalation, etc. And they create this set of indices that put together threats of acts and acts. You'll notice here the threats component is actually still moving higher, whereas acts is actually on the downswing. But we can see that with the Israel-Hamas attack here, with the Russia-Ukraine situation here, there's been spikes in risk. And while the geopolitical risk spike from Russia-Ukraine happened, then faded, and so crude oil faded, the bit around Israel and Hamas has not, at this point, unwound in a meaningful way. So what we're looking at here, seemingly, is still a bit of an elevated risk situation. So the question then is, well, this seems to mainly be about the threats, the yellow line, rather than the acts, the green line. So is this actually well-founded? Well, a lot of these risks are having to do with the price of crude heading to Europe. That's obviously the case when we talk about Russia and Ukraine. It is also the case when we're talking about Israel and Gaza, because mainly the issue is the supply of Persian Gulf crude through the Gulf of Aden, through the Red Sea, into the Suez Canal, and then into the Mediterranean. So we're talking about, again, European crude supply. It's a very easy way to check if there is some kind of a disruption. We look at the spread between the price of the European Brent crude benchmark and the US WTI benchmark to see if there's any extra geopolitical risk that is being factored into the European side of things. And as it happens, this thing has been hugging its average of about $5 a barrel for the better part of a decade. So we're not actually seeing any of these would-be threats realized in a practical way. There doesn't seem to be any meaningful disruption in the supply of crude, or else this market would look very different. And so, once again, despite the price action that we've seen, what appears to be the case is that there is a sea of crude oil supply, at least in the U.S., and the would-be supply disruptions that might be happening because of geopolitical risk are not. And so what we're left with is, again, this idea that the market is hypothetically fearful, that it considers that risk is elevated, doesn't actually have any evidence of that risk being realized. Just as long as there are wars, it is motivated by the possibility, perhaps, that there is risk. And so what that gives us when we look at the price structure is perhaps a selling opportunity when the price action confirms. Now, of course, this is still a trend of higher highs and higher lows, and we have indeed made some sort of a bullish extension here through this resistance just under 81, but the story seems more inclined to being something like a correction, a short squeeze, unclear what seems to be the case. And of course, over the course of June, we've had some additional geopolitical jitters here, but the overall structure seems overall the same. So, if anything, what this presents with confirmation is an opportunity, perhaps, to take a trade the other way. Now, as far as confirmation is concerned, that probably means a reversal back into here and maybe somewhere south of the 80 figure to essentially establish that this rally has failed. It has turned back inward, and the series of higher highs and higher lows, as defined by this low right here, has been violated. And if that occurs, then perhaps we have the short that we could be looking for as a actionable setup. And that is macro money for today. As ever, we are here every Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things might be going thereafter. I'm back on with Chris on Fridays for Futures Power Hour. I'll be on with Victor Jones for The Price of Truth tomorrow, just 30 minutes after this show, and back with him and Tom for First Call on Sundays. I'm also writing for the News and Insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.